Welcome, everyone. Our next session, we're going to be talking about building a bridge from independent sponsor to committed fund and things in between. There's in the independent sponsor community, there's a lot of different perspectives on this topic as to whether or not being a committed fund is in fact the promised land, and if so, what's the best pathway to get there. And different folks are on different kind of perspectives on that, and then folks are at different points on the evolution of moving to a committed fund if that's the direction that you wanted to even go. And our panel today is going to talk through some of these topics through their own experience and through their own lenses. But if we could start with like a little introduction of yourself, your organization, and kind of how you fit into the picture of this topic. Liz, we'll start with you. Sure,
thank you. And thanks everybody for showing up here. So my name is Liz Weindruch. I am a managing director at Barings. We are a global diversified asset manager with about 380 billion in assets under management.
Is the mic on?
I
don't think so.
Yeah. Am I on?
Nope.
I thought I was.
Check.
Hello? That's better. That's right. Okay. Thought I might have to project a little more. So hi, everybody. I'm Liz Weindruch. I'm a managing director at Barings. We are a $380 billion asset manager that really invests globally, kind of across almost all asset classes. For the purpose of this discussion, I sit within the private markets division on a team that is focused on investing in equity funds, doing equity co-investments with funded sponsors and independent sponsors, and making secondary purchases. And we do that all on behalf of an institutional client base. Our largest and most supportive client also happens to be our parent company, Mass Mutual Insurance Company. The reason that I am here and part of this discussion today is because we have done a lot of deals with independent sponsors in the last probably 2 to 3 years. We've always done maybe 1 or 2 per year, but that activity and flow has picked up pretty significantly in the last few years. And we're sort of agnostic as to kind of what your goals are. If you would like to stay an independent sponsor, we think that's great. If you're looking to build a committed fund, then we can definitely help you kind of through that journey as well. So that's me. That's why I'm here. Thanks.
Thank you. Nathan Chandrasekaran, independent sponsor based out of Seattle and San Francisco, was with a committed fund for 11 years called TZP Group. I was there when we had no money, and now they're about $1.5 billion. So I spent a lot of time on the fundraising trail. We've done a couple of transactions in the last 2 years, and we're exploring, like everyone else, should you go down the fund path at some point or stick to being an independent sponsor? And we've had a number of discussions with placement agents and stuff like that, but happy to dive more into that as we continue with the panel.
Well, good afternoon. I'm John Huhn. I'm managing partner of Compass Group. We're based in St. Louis. And since 2015, we've operated as an independent sponsor. We've built a team of about 15 individuals, and we've completed 9 platform transactions and about 100 bolt-ons. So moving along, and as a result of all that activity, we've made the decision to take the leap and raise a fund. So we're currently in the fundraising process, and hopefully we'll have our first close here at the end of the year.
Hey, good afternoon, everyone. Justin Crane. I'm a co-founder at Ceiba Capital Partners. I'm based in La Jolla, and my co-founder is based in New York. We are a private equity firm focused on business services, healthcare services, and specialty manufacturing. Really a buy and build strategy across all 3 verticals. Value creation strategy is really centered around tech enabling and digitally transforming businesses within those sectors. I'm here because I was an independent sponsor for about a decade, and as we've launched Ceiba recently, we are in pre-marketing mode right now, and this is not a general solicitation, but we are intending to go to market to raise a committed fund.
It's a more specific solicitation.
Yeah.
Hi, Geoff Nattans. CCP Capital is a private equity investment firm with professionals based in Greenwich, Connecticut, and Charlotte, North Carolina, where I am. Our strategy is lower middle market buyouts with a focus on aerospace, defense, and government, as well as adjacent sectors. My 2 partners and I come from a background investing from committed capital funds But following a spin out from a parent about a year ago, we've done one deal in the independent sponsor model. I think it's highly likely that our next transaction will also be in that model, but less certain what happens beyond that milestone.
So maybe to start this discussion, and I'd be curious to hear a number of your thoughts on this, but John, we'll start with you to launch us off in this discussion. There are pluses and minuses of the independent sponsor model versus the committed fund model. Recognizing that you've kind of taken the plunge, what are some of the things that you've thought about in looking at those two different pathways? And then I'd love to hear others as well.
Yeah, as I think about that, I wonder if it's too late to turn back, right? So we've taken that plunge. There's no doubt that the economics of the independent sponsor model are incredibly attractive versus a commingled fund where you're putting those puts and takes together. I think we also know that some of the challenges of that model. And for us, and we probably could have done some things differently, and we'll maybe touch on that later. But for us, we now have 8 different boards, 8 different board meetings, 8 different reporting packages, 8 different investor groups. And that has become a challenge for us time-wise. And that prohibits us from spending the time sourcing and growing the businesses that we have in the portfolio. So there is some give and take there. And we talked about it for a few years. And after a period of time, we came to the conclusion that we're going to make that leap and move forward. Certainly, there are some attractive things about a fund as well. We've all probably had that broker out there that claims an independent sponsor is risky and can't raise the capital. We can have a collective groan now. But as a result of that, having committed capital makes some of those closes easier and faster, which I think is important in today's competitive marketplace. We also think it's important for raising or recruiting individuals to our team. We've grown to 15 individuals, and it's more and more difficult to find quality individuals in an independent sponsor model because at least the younger crowd wants that stability and continuity over a longer period of time. So some of those pros and cons were weighed, and we ultimately made the plunge, and just last month started our fundraising efforts. And so far, so good.
Maybe pausing on one of the things you said there, Justin, how would you handicap the extent to which not having committed capital behind you at the outset is an impediment during the LOI process? Or because I hear mixed reviews from different folks and different approaches to the question as well.
Yeah, no, good question. I think that depending on the situation and the process and the intermediary, it certainly can have a negative impact. And I can personally, can think of a number of transactions that I wanted to close and was unable to close, and in terms of not winning. And I attribute primarily to being an independent sponsor. Obviously, there's things you can do to mitigate that. You can line up the capital earlier in the process, which we all know isn't necessarily ideal because there's a give and take as an independent sponsor when you do that. But that also, I have found, doesn't necessarily always completely address that concern from the sell side, especially if the group that you're bringing in, even if it's a funded group and you're putting them on the LOI, if that party wasn't there super early in the process, they might question whether or not how committed they really are to it. And so there are certainly challenges to it, but at the same time, and I've certainly made this argument as an independent sponsor and believe it, that there's opportunities to be more creative and resourceful and come up with some different approaches than as an independent sponsor to solve get a transaction done or shape up a transaction that maybe with a committed fund where you have a defined strategy, you don't have as much flexibility.
Yeah,
I was going to say, another challenge that I hear consistently is around the topic of alignment of interests and sort of the ability to, if you're operating as an independent sponsor, part of what I'm looking for as a capital provider is as you to be putting your own skin in the game, eating your own cooking, investing your own money into the transactions that you're doing. And if you're operating in an independent sponsor model, unless you have kind of tranched out your own personal wealth to do a handful of deals or whatever you're doing, I found that, folks end up kind of overextending themselves just from a capital standpoint by, putting it all in those first one or two deals. And then by the time the third deal comes around, they're out of liquidity. And so with a committed fund, you have your GP commitment that's a certain percent of the capital you're raising. That also, I think, is looked upon a little more favorably in the market if that part of that is done with a deferral of management fees. Whereas if you're investing in an individual deal, capital providers, at least I would like to see, kind of your own cash out of pocket going into that business.
Interesting. Geoff, what do you think on the economics from the perspective of how significant is the deal by deal? And then maybe also touch on kind of in your thought process, the fee apparatus of committed fund versus we heard the discussion an hour ago about management fees and closing fees. Those are not quite the same as 2% a year on unfunded commitments. How do you think about some of those dynamics?
Sure. I think it depends what your goal is. If your goal is to build an institutional quality GP, it's hard to beat the management fees on the committed capital model. You could try to recreate that with a independent sponsor approach, but I think that'll depend on your inputs for check size and fee amount and pace and other things. But I think you'll find that it'll take you multiple years and probably more capital invested to achieve parity with that traditional model of fees paid against committed capital, where you're starting obviously from day one or maybe zero with funding to build out your teams, and not just your team of investment professionals, but kind of support to execute on the strategy that you've described in that case to your fund investors. In the case of the independent model, if your circumstances provide, that could be a better fit. If you're looking for, or if you value the characteristics of that profile, or maybe perhaps some of the pros, we've talked about some of the cons, I think, heard them elsewhere during this conference of this model compared to committed fund approach. But if the benefits of the independent sponsor model really work for you, for example, the flexibility to organize your capital to suit a specific deal situation. In our sector, in aerospace, defense, government, there are some sector specific drivers where you can kind of create transaction opportunity or potentially value in organizing your capital that way. So that could be enough on its own. So I think it really just sort of depends what you're after, depends what your team looks like, kind of what your goal is.
Nathan, what would be your kind of as you look down your pathway, how do you assess some of those pros and cons?
Great question. So I guess I'll share two stories. When I was at a larger firm, I was an associate, worked my way up to partner, but was never part of the GP, had whatever, 4 or 5%, whatever the number is, because the three main partners had the bulk of it. I look at my classmate from business school who was an independent sponsor, and even though we had like $1 billion of capital, he had done like 2 independent sponsor deals, and I think his economic return to him was better than mine. Even though I had this massive fund and got a good salary, and that was like, that kind of clicked in my head. Unless you're like, if you're a small fund, unless you're part of the 3 partners of the GP, like I think you can make more money, right, if you're an independent sponsor by yourself. The trade-off is, the current income, right? Typically, like, hey, can you stomach not making whatever the numbers are? And the other thing I remember, like when I looked at his math, he'd end up getting carry on the rollover and all this other stuff. And I was like, wait a second, you raised like $6 million of equity and you're gonna have more carry value than I'll have on like $1 billion. And I'm like, what the hell's going on here? Right. And he's his own boss. And I remember doing that math and it comes back to so the logic in my head was unless our fund blew up to become a lot bigger and I got more some piece of the GP, I could probably make more and have more fun being independent as long as to your point, I could stomach the the risk of not having a salary for and covering the broken deal costs. And that is a big issue. The second thing is I have another friend, he's been very successful. He was at a firm called Mountain Gate and just left. And he has done so well. He's moving to an independent sponsor model. He's at a committed firm for a long time. And he says, I don't want to deal with LPs anymore. I don't want to deal with LPs and the reporting and the requirements and this and that and that. And he's done very well that he can do deals on his own. And that's the other thing that I'm sure you're starting to deal with now is just the requests for LPs, their diligence. I've been through it when our first fund, and it's excruciating the amount of detail that they want to see. They want to see everything.
Those damn LPs.
I take it as a compliment. I take it as a huge compliment, honestly.
Right.
They're fully engaged.
But the best part is like, they've got to manage, their investor base, what they're doing.
And the DDQs and the questionnaires and the on-sites and the operational DDQ. Yeah, no.
It's all about the playbooks. Make sure you have a playbook for everything. A playbook for sourcing, HR, recruiting, diligence. And so I think I spent like 6 months doing like 8 different playbooks, right, for when I was at this larger firm. We had a playbook for everything. And I asked an LP, like, you realize these playbooks make us less nimble? And she goes, I just have to check the box internally that I've got playbooks and part of diligence, right? No offense. And so again, if you can stomach the lack of the uncertainty, and you probably get the best experience out of all of us, like if you can make a ton of good money and have a pretty good business, if you can stomach the uncertainty of not having fee income and broken deals. But I don't know, I don't know if I'm answering your question, but those are the 2 data points that I've got that in my mind, my partner and I keep talking about is like, what do we want to be in like 3 years? So.
It's interesting you say that because there's, of course, 2 sides to every story. As I mentioned before, we have all these groups of investors in the platforms that we have now. And I'm sick of those LPs thinking that if I go to a fund, right, then at least I have one discrete group that I can deal with and it won't vary from transaction to transaction. But certainly the economics are better in the independent sponsor model. We've probably made more in a few exits in the independent sponsor model than we can expect to make out of the entire fund. But of course, you get some certainty there as well.
John, you just have the curse of being successful. I hate all these transactions.
But did I answer your question?
Yeah, no, it definitely cuts in numerous directions. And maybe we can talk some about ways within the independent sponsor model, ways to mitigate some of those minuses, as far as whether it's like pulling together capital from for each deal, going to different places. How do you think about mitigating some of the fundraising aspects of that, and especially as it's aimed at looking towards perhaps having a committed fund? Justin.
I'll jump in here. I think one way that I think maybe there's a lot of obvious ways, but I think one that maybe people don't think about as often is that if you have an investment thesis in a particular sector, right, you don't have to necessarily have the deals identified yet, but you could go figure out who the capital partners are that are most interested, and possibly even align yourself with one who's supportive of that strategy ahead of time, and one where you guys kind of have an understanding of what that relationship and partnership would look like, including economics, and then you can go out collectively and pursue something. So that's one creative way, I think. Not everyone, you have to have obviously the thesis, but then there's pros and cons to that. But that can be something that's interesting and effective, I think.
Well, let's stop on that, because I know there's different perspectives on that. So your thesis there is if you can kind of curate your LP list around a particular idea, it's going to be easier to execute on that particular idea. The counterpoint to that would be kind of a consistent group of LPs across multiple platforms. Does anyone else have thoughts on that dichotomy?
I would say, just from the LP perspective, it's a great idea, and starting to develop those relationships as you're building your pipeline and your thesis is really helpful. But LPs are so inundated with requests for everything and deal flow and funds and re-ups and all the things that they're working on, that I find that it's hard to get our attention without an actual deal in front of us. And that's just, I think that's just sort of the nature for how things are maybe right now. But it is good to start developing those relationships early so that, I know that when Justin calls me and with a deal and I'm like, oh, well, this is exactly what we talked about at the conference. And so I know this is what he likes to do and this is where his track record is. So having all that knowledge up front is really helpful because it helps me socialize it with my IC and the rest of the team. But it's going to be, there are some LPs that are set up this way, but not everyone is set up in a way to say, hey, yeah, we've got a checkbook for you when you come to us with your deal that matches, those parameters.
Yeah, I would just say, we don't have enough time to talk about all the things we did wrong, but what I can tell you is.
Let's give it a run.
I'll share a few things. We took full advantage of the independent sponsor model, meaning that you can be agile, you can do very dissimilar deals in size, shape, industries and markets, et cetera. And as a result of that, what we thought we were doing is being very strategic to match LPs to the check size or the industry or the type of business, whether we were expecting organic growth or follow-on acquisitions, et cetera. And so we curated the LP group for each of our transactions. Seemed to make a lot of sense early on. And as I've already suggested, we have a lot of very dissimilar LPs that want different types of reporting and different influence over the businesses or not. And that was really a big driver of why we said, hey, this is not sustainable as we grow past, 6, 7, 8 platforms. So the one thing I'd highly recommend is to find that small group. They don't have to be the same every transaction, but to find a small group of partners that can be knowledgeable about what you're looking at, value added when it comes to the type of partnership you want to have. And then you don't get this proliferation of LPs. We're making the LPs sound bad here. We love you, by the way.
So, and Liz,
it's a challenge.
Would love your thoughts on this as well, but do you think the broader list, like the way you did it, where you've got multiple different groups, you're also building relationships with a longer list of people. Is it better to have a shorter list of people that you have a deeper relationship with, or a longer list of people that you have some background with in that fundraising process? Or 6 of one, half a dozen other, or what do you think?
Depends on what you're trying to accomplish, but
Raising the money.
I think it depends. Like, so we just closed something recently. We ended up having term sheets from a couple larger equity, right, to do the one stop, I guess. And we ended up passing on all of them and ended up going down the individual high net worth path and ended up having like 20 investors instead. And part of that was controlling the deal, influence. And what we did is we put everybody on Cardo, right? And 2 of the family offices were so thankful that we did Cardo and not do like spreadsheets. And, so we're starting to see that these family offices are using Cardo, and that just helps from the reporting, KYC, all that stuff. And part of it also, as we think about fundraising for ourselves, is, and I'm not naming any names, we want to work with guys like Liz that can do funds down the road. So when we think about capital sources for our deals, I think I put them in 3 categories. There's the high net worth individuals. There are the groups that have capital like Liz. They also do funds, and then there's they're called the one stop that typically often are the private equity firms, right? That are probably not going to help you raise a fund ever, but they solve a lot of problems. They take half the economics sometimes, and if you're a buy and build, they're great. So I think it depends on what you're like. If you want to do a deal so I think because of what type of deal you're doing, so and what your goals are. So that's how I kind of high level classify the different groups. And we've stuck to 1 and 2, so we can go raise a fund. But if there's a deal that needs a lot of hand holding and we have the resources, we'll go look at 3, which is a full one stop. They'll take half the economics and great.
If you have the goal of raising a committed fund, I think you are also giving up a lot of that kind of nimbleness and flexibility to do a deal that may not be kind of within that, the strike zone for you. If there are certain sectors that you focus on, as an independent sponsor, you find something a little bit outside of that. As a LP and a capital partner, what I want to look at is, even if I'm looking at your independent sponsor track record, there's got to be some commonalities in terms of the size of the business and the sectors where you're focused and sort of the story that you're able to tell throughout your history. And it gets a little messy if you've got LPs that are, now taking board seats, or someone who's come in and they want, to be able to kind of influence decision-making and governance on certain transactions, but not others. It's a cleaner story if you're trying to, do something that's repeatable, and you don't need, SOPs on it, but just If you're saying, hey, like, this is the kind of deal we focus on, this is what we do, you do that if you're looking to raise a committed fund. Whereas if you're an independent sponsor and you find something that's just interesting and maybe a little off the run, you've got the flexibility to be able to do that. And you don't have to answer to somebody 5 years later to say, like, why did you do that? And, you were investing 5 million a pop and you invested 200 there. Like, what was going on?
So I'm hearing different kind of prisms that you can look through. There's the way you'd construct an LP base if you're trying to achieve control over the deal. There's a way you would construct it if you were trying to exactly look for fit with the LPs. There's a way you would construct it if you were looking principally for future LPs for a committed fund. Geoff, what prisms do you use?
I think what we've learned in our experience in this area is that it's the best approach is probably not to get too cute here, but to reach out to as many folks as reasonable, as you possibly can within the framework of what's achievable, against all the other things that you need to accomplish to get your transaction closed. And there's value, there really is value in long-term partnerships. This community that this community here that we're relatively new to, it seems like has really grown and is really, kind of maturing. And there's folks on the LP side that are specializing in this space, and obviously in direct deals, kind of versus funds. But there are some things in that process that you can't control. Thinking shorter term and longer term, and again, trying to sort of balance those objectives. You're going to run into some LPs who are interested in direct deals but don't do funds, vice versa. Something sort of in between. So, it's important to build those strong relationships that, sort of fit your situation now, your kind of go-to partners. Those are valuable, but it's also valuable to expand your base so that you're not so concentrated that something like that becomes a hiccup. The other major factor, I think, is just, and again, in the basket of things that the GP really cannot control is, kind of bandwidth and, investment appetite at, kind of an individual LP. We're, as I mentioned in my intro, we're sector focused in aerospace, defense, government. And, my colleagues and I have been doing that for 15 plus years. So we're at a different place on the learning curve than, partners, in this case, kind of capital providers who might be more generalist in approach. So there isn't always time, in a transaction to bring folks new to a situation kind of up to speed. And that also kind of introduces, there might just be sector, kind of issues that the NLP, won't necessarily get on the first one, but kind of gets around on the second one. So I think it's plus their own kind of just bandwidth, what else they have in the pipeline. If you're trying to introduce a new transaction, at the end of this month that needs to close by the end of the year, it's going to be challenging, right? With what everybody has on their plate. So I think it's the best strategy is to allocate your resources as efficiently as you can to get out to as many folks as is reasonable that you can track.
Liz, when we were doing our prep call, you, I think, used the term, some of your independent sponsor investments you view as a test drive for whether or not somebody's going to be successful that you might be a committed fund LP for. What's the best way that an independent sponsor could position themselves to you for that? And what's the worst?
So for me personally, what I'm looking for the most is a deal that fits the sponsor, right? So people are like, oh, like, what is your sectors and what do you like, what do you don't like? And I kind of put it back on the sponsor of what are you good at and where do you have a track record? And a lot of times an independent sponsor, we're looking at a business right now, actually, where the sponsor, it's a team that is spun out from an existing sponsor and they're going to be buying an asset or looking to buy an asset that they owned and operated previously. That to me is a little bit of a layup. I mean, that's sort of the ideal situation because they're They're buying an asset that they know the management team.
Hard to replicate.
It's very hard to replicate, but at the same time, it happens more often than you would think. So, and maybe it's not an asset you owned before, but it's in the same sector and you've got the same kind of, management team that you can bring back, you can get the band back together to kind of do it all over again. So it's got to be something that resonates with your track record and your strategy and what you do. And that to me is the most important than size, sector, shape, whatever, what have you. So that is the ideal scenario. The worst scenario, honestly, for me is, coming with something that is not, just doesn't fit your strategy and doesn't kind of fit what you do, or, you haven't come out with a clear direction of what you want to do. It's hard, I think, for an independent sponsor to be a complete generalist to then come with a deal, because it's hard for me to know kind of what your strengths are and what you've done and what you've been good at. So having some type of focus, maybe it's a type of deal, maybe it's a sector, or a geography even, but having a focus, I think, is really important.
John, we heard about kind of how you had constructed your LPs. So you can get a pass on this question, but the other, how often do you have recurring members of your LP group? Is it changed dramatically just in practice? Nathan was starting.
I got the pass.
Yeah.
Get the pass.
He gets a pass. We
So
heard.
in the 3 transactions we've done, it's been pretty consistent actually for the LP base. We were based in the Northwest. We've focused on high net worth and high net worth local family offices. And just because we live in Seattle, I've tapped into a lot of Amazon folks, right? And we've had a couple of those guys start investing. So we've tried to be consistent, and fortunately, none of them have been a pain in the ass, right? We give them quarterly reports. Everything's on Carta. They can check everything whenever they want. Everything that they saw in diligence is up in Carta, right? So it's all their K1s are up there. We only do C Corps because we're trying to avoid dealing with all the K1 and the state income allocation. I've done that in the past at my bigger firm, and it was painful, and the return offset wasn't as, I thought, advantageous. But I'm curious to get your guys' perspective on that. So we're trying to make it as LP friendly as possible, right? So when someone asks me, hey, when's my K1? If there's no K1, it'll be 0 because there's a C Corp in front of it. So yeah, we try to make it having gone through this 10 years of the fund and dealt with LPs, we have tried to streamline everything as best as possible.
I think the existings are,
So and that makes it easier for the LPs to come back.
Sure.
Because the first time you miss a K1 for an LP, which I've done with the bigger fund, it is not a good thing. If they have to file their taxes late because your K1 is late, there's a
They know
pissed
it,
off,
yeah.
there's a pissed off LP, and that is not good. So I've been there with the bigger fund.
that's true. For us, it's the folks you've done deals with are the first calls, and usually it's got more value than just a mutual benefit to just kind of bringing them in, and preferred access, if you will. But you can sort of they know how you think and vice versa, and you kind of socialize the transaction and get a good read, on how the rest of the community will view it. That's our approach.
Yeah, and we've done deals as an independent sponsor. I did deals with other GPs. I did deals where we clubbed it with a bunch of high net worth investors. We did deals with a group that backs independent sponsors, and we do kind of shared operating controls. We've kind of run the gamut, as well as a buyout shop we did deal with. There was some repetition with the high net worth investors, and there is one GP we did 2 deals with. So.
Do any of you have a perspective on using kind of deal placement agents for LPs for a particular deal?
I haven't considered it, so I don't even. I've never considered it.
The trade-off would be
Paying a fee, right?
you're ostensibly having some form of an auction-ish process on that part of the transaction, but there's certainly trade-off.
Yeah, we've never done that either. And I guess I don't want to sound too preachy here, but I think everyone in this room is either an independent sponsor, was an independent sponsor, or supports independent sponsors. And if we know, we've talked a lot about segments, and if you understand your segment or the area that you're playing in, whether that be a certain end market or a geography or whatever it might be, If you find a good opportunity at a fair price, if not perhaps below market, because you've done your work, the capital's there. So needing the placement agent probably is an indication that you haven't structured a deal that's attractive to the capital partners. That's one thing that doesn't change, whether you're an independent sponsor or a private equity firm, is that, you know, that's where you get real value. And I think that mitigates the need for a placement agent.
It's a little bit of a newer phenomenon too, just from my perspective, because I talk to a lot of placement agents all the time, and it's only in recent years that I've started to see independent sponsor co-investments. And I've realized that it is how, you know, and there's, you know, nothing negative here, but it is how placement agents are building their pipeline for future fundraisers as well. And so if you do want to always be an independent sponsor, that might not be the best match for you, because you're going to get either implicit or explicit pressure at some point to say, all right, we're going to do these deals and then we're going to raise the fund and it's going to be great. And we're going to build relationships along the way. And it is a good way to have curated relationships, because placement agents add a lot of value from that perspective. But I do think that it's their way of building their pipeline as well.
We've done both. It's for that reason, it's among others that there's value. We used one for our first independent sponsor transaction, just to sort of be introduced to the community, or, you know, kind of in some cases reintroduced under that framework. And there's value if you're using the right partner, I think, who, you know, where you can kind of get that benefit. And then beyond that, it's a little bit, again, kind of a resource oriented decision. Can you know, they be a force multiplier if you've got a small team? You know, or in some cases, if you're out on your own, you've got a lot to do to get this transaction closed. You know, our team, we're a small team. Our expertise and passion is for investment execution and management. You know, not necessarily arranging capital. You know, fundraising. We respect those relationships very much. It's obviously essential to what we do. But you know, in some cases, it may not be the highest and best use of your time if time is tight. And so I think it's looking at, you know, you need to make an assessment for yourself about the state of your relationships, you know, kind of your P-win to get done what you have sketched out. And it might be that you need to fill in some gaps with a partner like that.
Quite right. Liz has to run to a flight. She's not leaving in a huff, as far as I can tell. But do we have any questions from the audience for this august remaining group?
So mention the difference between funded, like bid fund economics, call it 20%, and if it's possible, whether it's 5% or whatever. But you left out the fact that with the proliferation of like stakes aggregators, whether it's Petershill or Dial or Blackstone, your GP as a funded group is worth a lot. Does that play into your decision making at all?
I'll take a crack at that. I think it's a factor for sure. You know, when at least in my own, speak for myself in my comments, that's not the primary consideration. But if we can, you know, if we can generate fantastic investment outcomes, you know, for ourselves and for our, you know, investors, and then at the same time build value in a GP to the level that, you know, it'll be interesting to the firms that you describe. I think we're doing some things right. So but that should be a material consideration in how probably a multi-year plan for your organization, but balanced again against your short-term needs to get your deals done.
I was going to say the opposite, because it takes a long time to get value in GP. It's like a 15-year, you know, view to get that, to your point. Again, that's my perspective. I haven't been at the fund for a long time. Like even after 12 years, we still couldn't get the value of the GP. So I don't know. I think it just depends on what your goals are. I don't know if you get
I don't know that there's, well, I guess I'd back up. I know my background is more entrepreneurial, and I think a lot of independent sponsors like that. Be your own boss and do your own thing. And therefore, planning to be sold or have a GP component sold is probably not in the DNA, not my personal DNA, and I would say it's probably not a match for many, but it certainly could be value over time. With that said, a few years ago, I never thought I'd be up here talking about raising a fund because I thought those people were crazy, and here I am, maybe crazy.
Not you're crazy.
Yeah.
It can be an accelerator. It's a mitigant for some of the cons or weaknesses in the independent sponsor approach, where it can take longer and become challenging in a closed ecosystem, that is, without sort of an outside source of funding or funding from a balance sheet. If you got the capability to do that personally for your team or your organization, but that can be those kind of stakes can be sort of an accelerator for that, even for smaller firms. And I think there are some firms out there doing it, at a much smaller scale than the firm names that you mentioned. But that's something that's out there if you need some resources to build out your team to be able to get your organization to where you want it to be.
Thank you guys for participating in this discussion. The next discussion in this room is going to be views from capital providers. So that should be an interesting one, especially for independent sponsors. That's usually a pretty popular panel. So stick around for that. But thanks again.